The Labor Department reported a contraction in non-farm payrolls for the latest month, with payrolls declining by 42,000. Consensus expectations had centered on a gain of roughly 160,000 jobs. The prior month's reading was revised down to 98,000 from the originally reported 142,000. The unemployment rate printed at 4.2%, compared with expectations for 4.1%. Average hourly earnings rose 0.2% month over month, below the 0.3% consensus. The prior earnings reading was unrevised at 0.3%. Labor force participation held at 62.6%, unchanged from the previous month. Private payrolls accounted for the bulk of the decline, with losses concentrated in manufacturing and temporary help services. Government employment remained modestly positive. This is the first negative payroll print in over 2 years. A contraction in payrolls changes the near-term interpretation of labor market momentum and introduces downside pressure into the growth component embedded in rate expectations. Payroll growth is one of the core inputs shaping the expected path of policy rates. A negative print increases the probability that labor demand is cooling faster than previously priced. Rate markets respond to this through the front end of the Treasury curve. When payroll momentum weakens, traders reassess the likelihood of further tightening and shift focus toward earlier easing or a longer pause in policy rates. The immediate adjustment typically appears in 2-year and 3-year Treasury yields, where policy expectations are most concentrated. This also affects forward rate pricing embedded in futures markets. Fed funds futures and overnight index swaps begin adjusting terminal rate assumptions and the timing of potential policy shifts. Even small payroll surprises can move that pricing. The wage component matters as well. A softer average hourly earnings print reduces the perceived persistence of wage-driven inflation pressures. That channel interacts directly with the inflation outlook embedded in rate expectations. The result is a recalibration of near-term policy probability distributions. U.S. Treasury yields typically react first to payroll surprises, especially when the headline deviates materially from consensus. A negative payroll print generally compresses yields across the curve, with the largest moves at the 2-year maturity where Fed policy expectations dominate pricing. The 10-year yield tends to respond through growth expectations and term premium adjustments. Curve dynamics also become important. If the front end falls faster than the long end, the curve can steepen modestly in the immediate reaction window. Liquidity conditions around the data release often amplify these moves. Equity markets tend to interpret weak payrolls through 2 competing channels. Slower labor growth can pressure earnings expectations if investors believe it signals weakening economic activity. At the same time, softer labor data can support equity valuations through lower rate expectations. The balance between those forces determines the index response. Cyclical sectors, including industrials and consumer discretionary, usually show greater sensitivity to labor market deterioration. Rate-sensitive sectors such as technology and utilities can react differently if Treasury yields move lower. The U.S. dollar generally trades in line with rate differentials following labor market surprises. A payroll contraction tends to weaken the dollar if markets interpret the data as increasing the probability of policy easing relative to other major central banks. Currency markets focus heavily on front-end yield spreads between the United States and other developed markets. If Treasury yields fall while foreign yields remain stable, the dollar can soften against major currency pairs. The magnitude depends on how aggressively rate expectations reprice. Credit markets typically widen modestly when labor data deteriorates. Payroll contraction raises concerns about corporate revenue momentum and broader economic activity. Investment-grade spreads may move slightly wider, while high-yield spreads tend to react more quickly due to their greater sensitivity to growth expectations. Liquidity conditions in credit markets also matter. If Treasury yields fall sharply, the underlying rate move can partially offset spread widening in total return terms. The next key catalyst for markets will be the upcoming CPI release, which will test whether softer labor momentum is accompanied by continued moderation in inflation data. Rate markets will also focus on the next Federal Reserve policy meeting and any updates to the summary of economic projections. A meaningful repricing would likely require either a second consecutive weak payroll print or inflation data that materially diverges from current expectations.